What's up, YouTube? It's Todd Horst here with Tasty Tracker, and I got a request to do another challenge video, so I'm going to go ahead and do that. The reason I haven't made one before today was because I didn't actually do anything. So the market was going down, and that's fun to talk about, but I hadn't rolled or closed or opened any new positions. As it were, though, today I did open up another position, so I will go over that here in a second. But just a little bit of context. On the third episode, we were at 1844. In the time since then, I've lost $630. Again, that's on paper. That's not necessarily reality, although it could be at some point. And that takes our net liquidity down to 1214. So these things I wanted to talk about today real quick. We're just treating your trading like a business. So I've written out a couple plans. I actually wrote a like 35 or something page paper in December that was a culmination of everything that I learned and what I found to work the best. So you might want to write something out physically. I typed it, but you know what I'm saying. So that you can have all your thoughts in place, and I've used that document since December to guide all my trading since then. But the entire past year and a half, I've been testing out different theories, some completely stupid that I knew were going to fail, such as just randomly selling any symbol that had a high IV, because the more you learn, you'll find out that IV is overrated. So if the IV ranking is high, then you can capitalize on that inefficiency. So I mean, just to finish out that example, I found out that the reason they were higher IV was a lot of times because they were about to move, and so that might work if you can call it correctly, but it's sort of like earnings, where it turns out most of the time you can't well, I'll say not most of the time, but it's very hard to predict where things are going to go. Sometimes things go the direction you're wanting to, but the market decides otherwise. So for example, you might think Google's going to beat earnings. They do beat earnings, but the stock ends up going down. And even though as a seller we would benefit from the IV crush that the buyers are hurt by, the market, for whatever reason, wants to sell it off. Maybe they were expecting more. Anyway, the whole point there is that I'm constantly testing theories. At the phase I'm at now, I'm spending less money on testing theories, but I'm still constantly trying to find my sweet spot and evolve that as time goes on. And part of that, the last comma there, is to learn everything. I want to learn everything from anyone I can. I think it's pretty stupid if you don't think that you can learn something from everybody. Everybody has something that they can teach you, and sometimes it's just as simple as somebody saying something differently and you hear it and it triggers a thought process that you would have never had if you didn't listen to that person. So I'm not necessarily saying to actually try everything you hear, but it isn't a bad idea to get as many perspectives as you can. So anyway, some of the sub-bullet points here, if you were running it like a business, would you just throw money willy-nilly at the wall to see what's stuck? No, you would try to plan out different courses of action and see what's most successful. Would you keep a ledger? Of course you would. You need to know where your money's going and where your returns are coming from. That's the whole purpose of tastytracker.com. It's a personal website for you to see what you're good at and what you're not good at, so that you stop doing or educate yourself more in the areas that you're deficient in, and really focus in on what you're successful at. I will have a little video coming out in the next couple weeks talking about the reason to sign up with a Tasty Tracker account. But for now, I think that'll suffice. Okay, so yeah, of course you're going to track your successes and failures, and you're going to invest your time in education and implementation methods, as well as your money. So whether you're buying books or paying for trading alerts, the only thing I would tell you there is make sure the person that you are following is actually giving the reasons why they're entering into positions and what their thought process is. There's nothing worse than just following somebody's recommendations blindly. I would definitely not do that. You need to understand what they're thinking and then follow them for a little bit, and then you can cancel your alerts if you want to, because you'll have learned what you needed to learn. The last couple bullet points here is you want to take out some money every once in a while. I think people, although I've said before about divorcing yourself from it actually being money, at the same time, if you are profitable, you need to take some money out to get something nice to keep the motivation and realism up. It should be a number on your page that's meaningless, but at the same time, it should be meaningful. I know that doesn't make any sense, but hopefully you understand what I'm saying. You need to be able to celebrate in your wins and make sure that you can keep going with it. Sort of the very last thing here. Oh, wait, I forgot there. One bullet point is most of the people are coming from Wall Street Bets or something like that. And buying calls typically is not a profitable long-term strategy. It's definitely something that you should be doing to supplement what you're doing primarily. But the buying calls or puts is something that I do a smaller percentage of the time. We'll say 5% of the time. Well, maybe with 1% of your capital, you can use that on the really long shots that chances are will always be a waste. But you should only focus on doing those gambling once you have a process that's working and making you steady income. Why would you try to have a gamble be something repeatable? I mean, those are just they're at odds with each other. So it's not going to work out. You can't gamble and consistently be profitable. But that doesn't mean you shouldn't gamble and with a little bit of your money, a little bit of your proceeds from your stable income, and maybe you'll hit on some of those. And then if you do hit, I wouldn't suggest that you take that and gamble with all of that. Again, I would take 99% of that and put that in my main account, or use it with my main strategy, and then again gamble with 1%. That's just my personal preference, but do whatever you want. Anyway, the last point here is with a small account, I really think you need to go slowly. So I typically will only put one position on a week, maybe one position every 2 weeks, because I want to have my portfolio move with the market as much as possible. So if I put all my positions on today and then sit on my hands for 2 weeks, that's nice, but in the meantime, the market may have gone up 20 points. And so I'm stuck behind. Whereas if I put a position on this week and then one position on next week and one position on the following week, all with different expirations, all with different tickers, you're going to really diversify as much as you can. And obviously there are those chances where there's a really good opportunity. So I'm not saying to just totally forego investing in that. I'm just saying, the slower you go is usually the better. So I am going to talk about position sizing and account allocation a bit later. But just to get into the nitty gritty here, of course, today we're sitting at around an 8 or 9 on the fear index, which is just crazy. For the past couple months, we've been definitely above 50 and typically in the extreme greed area. So that sort of shows you how far we've come with the market in general. If I hop over here to SPY, that's still Facebook from my last video. Okay, so I mean, I have a lot of lines on SPY. it's actually this 288 line that it's resting on. I have from a bit ago, incidentally, and then I have the next line going down to around 280. So hopefully we hold out here, but you can see the volume today is the first day in the last many days where it's actually been green. So that might be a sign that it's weakening. We've also really bottomed out here on the RSI, and the MACD hasn't started turning yet, so I wouldn't get too crazy. But this downward move could be weakening. You definitely have to put this in context here, though. The past 1, 2, 3, 4, sort of the past 4 months, we've been slowly building up, and then in as many days as it took months. So 4 months and 4 or 5 days, that's all completely undone, and we're back down to this range that we were hovering at for the previous 6 months or so. So what I guess I'm saying there is, obviously there's the ability to go down further. However, there's pretty strong support. The further you go down, the more the market wants to keep it where it's at. And we've had such a large move that it can't go forever. And then the question becomes, if we're nearing the end of the primary drop, how quickly will it snap back? Will it jump right back to where it was, or will it just pop back another $10 and we'll end somewhere in the 300 range? I don't know, obviously. So I was only slowly putting on positions. Okay, so what was the last one? I'd done Microsoft, I think, was the one before. So today my position, I am slowly adding them on. So I guess another way I should put it is, when the market is going crazy, you should continue what you're doing, just go at a slower pace, and understand the risk associated with it. So today I put on this SPY position. It was jumping all around from like 110 the whole way up to 200. So I was able to get it to 180. So right now it's sitting at 130. I'm not sure if you'll actually be able to get a fill on that or not. But what this is a long call, 341 strike for SPY, and it's not till the September expiration. So we have over 200 days for SPY to get back up to 341. And if we jump into SPY real quick. Okay. For strikes that are somewhere around the money, at the money, they're right around $1,000. So if you get a call here that is 289, it's 935. Okay, so the thought here is that if SPY were to get back up to 341, which we can see the high here was 339, so it's right at where it had hit highs previously. If it can get back up to that place, it should be worth around $1,000. I paid 180 for it, so I would be getting sort of a tenfold there. Or I should say 5. So that's basically $200. But anyway, I will have made 5 times, and I have until September for it to regain what it once was. So as it is, the chart looks really messed up. If we stick around this area for through all the expirations, then I will basically lose everything. But that takes me to this screen, which is Tasty Tracker, where the default sorting is by expiration. So we can see the only expiration I have coming up here is Apple in 21 days. I did look to see if I could roll for a credit, and I couldn't at this point. So because I can't roll any of these for a credit, I'm just going to sit on them and hope that the market rebounds. But because I've staggered my entries here from days to expiration 21, 49, 112, and then 203, the odds of me totally blowing up the account are pretty small. The other thing, I'll go back, because this is a $2,000 account initially, you can see the cash I have actually is 28. I still have 513 available to invest in something that if an opportunity pops up, or the market continues to go against us and I want to continue to put on bullish plays, or maybe I might do a short-term bearish play if the market looks like it's going to continue to go downward. But anyway, I think that's really all I wanted to talk about today. Hopefully you have a good weekend, and thanks for putting all the comments in YouTube. Obviously, the thumbs up and the comments help the YouTube algorithm, and I enjoy everybody's opinions and different perspectives, and so feel free to comment below. Thanks, guys.